Good morning and welcome to the AM Volatility Report, sponsored by your friendly neighbors at Option Pit. Good to see everybody. Reminder, none of this is investment advice. This is for educational purposes only. Consult your financial professional. Options have risk. Be aware. So let's talk about the world. And that it is currently the market's oyster. We're S&P back over 2,100. Long 3-day weekend, vol should have been up about a point, and it's only up about 0.8 now, so you can see vol's backed off. And you can tell vol's backing off because VXX is down, UVXY is down, so the vol ETNs are down. There's really not a lot of areas where vol has actually popped. VVIX, and this is a key one to look at. It got absolutely slaughtered going into the long weekend and basically touched levels that we have not seen in 6 months or a year. I mean, going back a year, we had not seen levels like this. You have to go back to June of 2014 for vols to, after the Greek thing kind of got solved for vols to get anywhere near as low as they are. So hedging is becoming an interesting piece. So hedging with VIX is becoming less expensive as I look out. And that's even with now Brexit priced in, and with Brexit priced in, and with potential Fed rate hike, you can see volatility is not expensive. I mean, June going out, about 2 weeks in the 70s, first time we've seen that in a while. July is the most expensive month on the board, but even at 78, that's not that expensive from where it's been. There is some serious changes in kind of vol structure right now. It's just a lot cheaper to trade. It's a lot cheaper to hedge, a lot cheaper to trade right now, which is interesting as we look at it. That's kind of it's very interesting the way things are. Now, do I think that's going to last? I think today is an excellent day to set up hedges, and I would be looking to do that because I think that things are about as cheap as they might get in terms of vol concerns for the next couple of days. You've got your day off here, and then starting tomorrow, people are going to start thinking about non-farm payrolls and Fed rate hikes and Brexits and things like that, and that could have a profound effect on the vol and volatility. So we think, and we'll be writing this, we do some research out there, we'll put out research that now is the time to hedge. If you're going to hedge, the market's giving to right here. VIX at 14, just be aware. All right, so now stocks moving. Apple kind of flat on the day. Your Facebook's flat on the day. So some of the hot stocks, pretty flat. You're getting a little bit of juice out of Amazon and Google, but that's it. Financials continue to power higher. JP Morgan's up. Goldman Sachs is up. So you've got your financials that are really, I think, moving significantly higher. And we continue to see bonds back off. And, one thing we are watching is that we think bond vol is too cheap and that bonds have real potential to pull back and drop. And so we like owning puts. We like owning put spreads. We like owning put counters. I believe we have a put counter in the strategy letter or a double counter, although I think it's going to end up being bearish. That's the way we think the market sets up for the time being, and there's going to be some hedging and some scooping going forward. And we are encouraging people to take advantage of the VVIX below 80 to capture volatility and capture volatility premium. So financials leading, energy leading, kind of tech and the balance on hold. I would also note that consumer staples continue to be soft, and that's because of the potential for dividends to become a little less important. So, you know, Dow flat, SPOO's flat, a little bit of a rally a little bit of stronger rally in Russell and NASDAQ, but they don't look particularly strong either. And as we stated, we think that today is a day to set up hedges. All right, folks, if you have questions, you can email me, marketoptionpit.com. You can call me 888-TRADE-01. Have a good morning.